CFA Society Atlanta. I'd like to welcome you all to our online series, Capitalizing on Uncertainty, the Value Advantage in Non-US and Emerging Markets. I'd like to provide a special thanks to today's sponsor, Pzena Investment Management. I also encourage you to join us and register for our upcoming annual meeting on June 16th, featuring a conversation with BlackRock's iHub team. For all of our members, please remember to cast your vote on our annual proxy, and while logged in, please participate in our annual member survey. It is now my pleasure to turn it over to Martin Hanhauser, Director of Business Development and Client Service at Pzena Investment Management, who will be introducing today's speaker. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And without further delay, I give you Martin Hanhauser.
Great, thank you so much. On behalf of Pzena, I would like to thank Kathy Ford, Aaron, and all of the CFA Society participants today for inviting us to join you. We're thrilled to be here. We look forward to an engaging conversation. As Aaron mentioned, my name is Marty Hanhauser. I cover the East Coast, including the greater Atlanta area for Pzena. Any questions pop up following this meeting, please feel free to reach out to me. I'm happy to have a conversation. Before I turn it over to Allison, I just wanted to give you a quick background on who Pzena is. Pzena was founded in 1996, and we are based out of New York City. We are one of the premier value managers in the industry. At the end of April, our AUM was $50.3 billion. Of that total, 7.2 billion approximately is in the EM value strategies that we manage. We offer a variety of different vehicles, mutual funds, separate accounts, UCITS, CITs, and other vehicles that our institutional and retail investors have access to. When people think of emerging markets, they typically don't equate value investing to this asset class category. It's dominated by growth managers if you take a look at the statistics, whether it's eVestment or Morningstar. That said, Pzena has one of the few dedicated value EM strategies in the space, and we've continued to stick to our discipline in challenging times. We're excited about how our portfolios are positioned, and we do think that there's a unique value advantage when you take a look at our style of investing in emerging markets. With me today is my colleague, Allison Fisch. Allison has been with Pzena since the year 2001. She is a partner at our firm and one of our co-portfolio managers on our emerging markets value strategies. She's also a co-PM on our international strategies and a few other ones as well. When we started investing in emerging markets in the early 2000s, we did a lot of research on whether it made sense to enter into this space. And that research and initiative was spearheaded by Allison, and she's been a member of the portfolio management team ever since. What she's going to talk about today, and you've heard numerous times, is the value advantage in emerging markets. And without further ado, I'll pass it over to Allison. Thank you.
Thanks, Marty, and thanks to everyone who's joined us today. We really appreciate you spending your lunch hour, hopefully, with us. So before we dive into the specifics of how value works in emerging markets, I think it would be helpful just to give a little bit of background on value investing in general and how we think about ourselves as value investors. You know, value investing can mean a lot of different things to different people. And for us, it means a real focus on buying businesses that are cheap relative to their normalized earnings power. If you go to slide 4, we can sort of walk through the investment philosophy behind this. But essentially, you can think of normal earnings power as what a company should earn in a relatively benign environment, sort of a mid-cycle level of earnings. And so when a company is cheap relative to that metric, it means something bad has happened, right? The company's earnings have collapsed, the stock price has collapsed, the market thinks that this business is permanently impaired. And then it's the work of our research team to figure out, is this a temporary problem or is this a permanent problem? If it's a temporary problem, then we're happy to invest because the earnings power should be restored and so should the stock price. If it's a permanent problem, those are the ones we want to avoid. The last 2 points on the page here are important to keep in mind as well when you think about value investing with Pzena. The first is the company's business is good So we're looking to buy fundamentally good businesses. It's not just about optically cheap junk. And then finally, we look for significant downside protection. So we are deep value investors, which means we are investing in the cheapest portion of our investment universe. We already know, therefore, that if we get it right, the potential upside is really big. So the key here is to make sure that we're guarding the downside so that when we get it wrong, we don't lose that much. And this is how we can create a really attractive risk reward skew in all of our investments. The way that we go about doing this is a very systematic process, which we've been using for our investing since the inception of the firm. It begins with a quantitative screening tool. If you wouldn't mind going to the next slide. The tool is called Stock Analyzer, but basically what it does is it generates a naive normal earnings per share number for every company in the investment universe. And then we screen based on looking at the cheapest companies in the universe based on that number. So if you take the entire emerging markets universe, 1,500 companies, every day we can open up this tool and see this naive normal earnings per share number for every company. And then that valuation metric of each company's stock price divided by that number. And then if you rank them number 1 all the way to 1,500, we're focused on the cheapest 20% in looking for new investment ideas for the portfolio. Once we identify companies that look interesting, on the next page, we have a 2-part research process. So we've got an initial review period and then a full research project. During the initial review stage, the analyst who covers that industry will be trying to figure out what are the key issues affecting this business. Why is it cheap? Why have the earnings collapsed? So the analyst will begin to make a model of earnings for the company, sort of driving towards an initial view on what this normalized earnings power could or should be. Once he or she reaches an initial hypothesis on whether this company looks interesting, he or she will bring it into our research review meeting. That's a meeting where the analyst will sit down with the portfolio managers on the strategy, and there are 4 of us on EM, for example, and we'll all discuss whether this company looks interesting enough to become a full research project. Most ideas get rejected at this stage, and that's a good thing because the full research project is a very, very deep dive into the business. At that stage, we're building very detailed financial models, really driving towards a fully formed view of what this business should earn. What is the normalized earnings power of this business? All of this work will culminate in a visit on site to the company, wherever they are in the world. So normally we spend a lot of time traveling. Obviously, the last year has been an exception in that respect. So we've been doing these visits on video or by phone. And the purpose really is to audit our view of how this business operates with the people running it, and to make sure that the path to recovery that we see is the same, that they see as well. All of this work will culminate in a fully formed vision of the normal earnings power of the company. The analyst will bring it back into that research review meeting. And if we all agree on that number and it's still in the cheapest portion of the universe, we can add the stock to the portfolio. Very briefly on the next few slides, I just want to share with you our sell discipline. So quite simple, we're buying the stocks when they're in that cheapest portion of the universe, the first quintile. Once a stock reaches the midpoint of the universe, so just average in valuation, it has to come out of the portfolio. Now you may find, that we're selling stocks ahead of that or trimming them to make room for more attractive opportunities. That's fine. The key point here is that we won't continue to hold the stock when it's in the more expensive portion of the universe. And that's how we really maintain that discipline on value investing and maintain our role in our clients' portfolios as that deep value exposure. And this is the same process that we use across all of our strategies, whether they're domestic, emerging market, or developed international markets. So just briefly on the next page to sum that up, we do one thing, value investing. This process, which I sort of briefly walked through, is the way that we have done it for 25 years through all market cycles. The research is really the key here. If we can drive our decision making with a view to the normal earnings power and correctly bound the downside with that downside protection, then we can create these really attractive risk reward skews. And we do all of this with one research team. We have a global team where analysts are assigned to industries that we rotate every few years. And the idea here is to have a really flat structure, really working together on all of these projects. So this is really the background of where we're sitting as value investors. And then when we take this approach across the world, as Marty said, I did some work on this going back now 15 years, I guess, to decide whether we should launch this type of approach in emerging markets. And what we found was really quite heartening. If you go to the next slide, we can take a look. And really, if you think about emerging markets, most people think that they are all about growth. And so that's where people are going when they're looking for growth. You do not find a lot of value investors there. So when we set out to begin our strategy, which launched officially in 2008, one of the questions we had was, well, should we? And so we took a lot of look at what had really driven outperformance in emerging markets investing historically. And it actually has nothing to do with growth. In fact, you can outperform in emerging markets investing in two different ways. One is by using a momentum-based approach, and the other, it turns out, is by using a valuation-based approach. And this chart, it shows a sort of a picture of that. This was some work taking the most expensive and the cheapest companies in both developed markets as well as emerging markets, going back to 1987 and saying, what would have happened if you bought baskets of those stocks? So for both developed and emerging, you're buying a basket of the cheapest and a basket of the most expensive stocks. And then we're going to hold those stocks for 1, 2, and 3-year holding periods. What happens? Well, as you can see on this page, sorry, it's a little bit busy. Hopefully you have a good size screen at home. The cheap stocks outperform the expensive stocks in all of those periods. That's sort of the first observation. So good to see, value works well in emerging markets. The other piece that's notable here is that valuation advantage gets bigger over time. So the longer you're holding these cheap stocks, the better it was for returns. We find this to be heartening for our approach and our philosophy as well. This idea of normalized earnings takes time to play out. Our average holding period is somewhere in the range of 3 to 5 years. But the other observation from this page that we found particularly notable is that valuation advantage of buying the cheap stocks is actually bigger in the emerging market space than in the developed market space. And this isn't something that you hear a lot about. So we dug into that a bit more, and what we found was sort of the underpinning element here was that those valuation spreads, which get wider and then shrink up, and that is the value cycle, tend to do that much more dramatically in emerging markets. So when they get wide, they get even wider, and when they tighten up, it's that much more extreme. And when you dig into what's underneath that, it actually does make sense, right? Because what drives the value cycle is that investors are not entirely rational, right? If they were entirely rational, then none of this would ever happen and you wouldn't have these valuation spreads widening out and narrowing. But what happens is people get scared. And when they get scared, they want to sell off the things that feel scary and cling to the things that feel safe. And that's when spreads widen out. And nowhere is that more extreme than in emerging markets, these sort of far-flung, less well understood places with a real mix of businesses and real uncertainty. Then when we move forward in time and maybe it looks like the world isn't coming to an end, so we want to take some risk, then all of a sudden these companies that were sort of thrown away and got super cheap, thinking they were uninvestable, these countries even that were considered uninvestable, the investors rush right back in because they want to juice those returns and those spreads tighten right back up. And so it's really this sort of cycle of fear and of excitement that drives the value cycle. And it does make sense that emerging markets, given their more unknown nature, would be a place where you would see that to an even more extreme degree. And that is what we've seen historically. Another thing that we took a look at on the next page was, well, what if you're a long-term investor? Are you better off in a value-based approach in emerging markets or buying the index? And so each dot on this page is a 5-year rolling return where we compared the index to a naive value portfolio, here defined as low price to book. And so that diagonal line through the page would be the two portfolios performed exactly the same. as you can see, many more dots above the line, which shows you that the value portfolios tend to outperform. The other thing that I think is kind of interesting on the page is where the dots are relative to that line. You can get a much bigger degree of outperformance of the value portfolios than you see in terms of underperformance over the time, just given that bigger spread of the dots on the upper part of the page. And then the other piece that I find kind of interesting, though maybe it's also sad, is everything to the left of the y-axis. Those would be the periods, the 5-year periods where emerging markets returns were negative. So hopefully, we don't have to live through too many of those. But what's interesting is that even in those periods where the index return was negative, you were better off being in the cheap portfolio. So I think that's a pretty interesting thing, that I noticed in this chart. So clearly, the data would suggest, going back historically, that a value investing approach in emerging markets is a very good idea. Now, that said, with the exception of the last 6 months, it has not been a very good idea since we started doing it. And if you go to the next page, you can sort of see why. So what we're looking at here, and this is globally, is valuation dispersion. So to explain what this chart means, this is if we took every stock in our global universe and we looked at its valuation on price to book, and then we looked at the cheapest 20% of the stocks versus the most expensive 20%, and what is that spread in valuation. So in a normal long-term average of that spread in valuation, just between the cheapest and the most expensive, that should be at the 0 standard deviation row here. So as you can see, we are way above that. And the reason why I say, with the exception of the last 6 months, you can see the last 6 months, that line coming down. That line coming down is the fantastic performance of value that we had in the fourth quarter of last year and the first quarter of this year. But the rest of that, the line steadily moving upward over most of the last decade and going basically vertical for the first part of 2020, is value underperforming. Its spreads continuing to get wider and wider. And on the next page, we can take a look at this regionally, and it tells a very similar story. So here you can see, the exact same type of analysis, looking at the cheapest versus the most expensive in the US, in Europe, in Japan, and in emerging markets. And across the board, what you see is those spreads really blowing out in the first part of 2020, COVID hitting, and huge, very dramatic underperformance of deep value. And then over the last few months, those spreads really coming in, dramatic outperformance of deep value. And so this is where we're sitting today. Value has had a very, very rough time, and now it has started to work. And so the question is, when we see this kind of dramatic outperformance by our portfolios, how much do we have left, right? Or for people who weren't in value, did I already miss it, right? So what I think is interesting here, and this is just looking at things graphically, is if you look at this page, you would say, well, it looks like we still have a long way to go. That 0 standard deviation being the long-term average, where valuation spread sort of should be in a historical context, is still quite a distance from where we sit today. I mean, in emerging markets, we're still more than 2 standard deviations away from that sort of normal spread environment. And in fact, the spreads are so wide today, it looks like the late 90s, which was, a very different environment in emerging markets. So, looking at it from that perspective, you would say, okay, it should go down. But that's just looking at a chart, right? The chart could be nothing, it could just as easily go up. So the way that we try to analyze this is looking at where we are versus history, and what history can tell us, what the economic cycle suggests, and what the company earnings are telling us, which is really key in terms of what performance can happen moving forward. So on the next page, you can see we tried to put this into the context of history. Now, this is a bit of a busy chart, so let's just take a minute here. So this is looking at US data, because that's really the best data that you can get going back the farthest. So we went all the way back to 1969, and we tried to identify the value cycles that the market has experienced. And as you can see, we identified a number of pro-value cycles going back historically. And those in the picture are those yellow shaded areas. So those are the periods when value was outperforming. And then we looked at what was the relative performance of value for that period. So how much did you get paid to be in the value portfolio relative to just owning the market? And then how long did those periods last for? So as you can see, when we lay them out below, the relative performance on average is 138% during those periods. And the average length of those periods is 62 months, so a little over 5 years. So far, this cycle, we're looking at 39% of relative performance and 6 months. So if history is our guide, we would say this is likely to go on for a lot longer. Another thing I think that's worth just touching on before we move on is if you look at this page, the other thing that you can notice is that when there is a longer period where value isn't working, so a longer period of sort of white space between those yellow blocks, you tended to get a longer and more dramatic pro-value period coming out of it. You can see that, and particularly in the early 2000s. So if that is any indication of what's to come, that may suggest that we're going to get more than that sort of historical average, because we do have quite a long period where value was not working, leading up to this very short period where value has started to turn again. So in the context of history, that does look quite supportive. But what's driving the history? Well, a few things can drive a turn in the cycle, but a really typical one is a recession. And that's exactly what we're experiencing here, or have experienced, a deep and short recession due to the pandemic. And the markets are behaving just as they always have done historically in that context. And the next page gives us some of that historic context. So what we looked at here was, how does value perform in a recession, which in this case began in the second quarter of 2020, and then how does value perform after the recession? And for this analysis, we looked at the US again, because we can go back so far. We were able to identify 14 recessions going back to the Great Depression. And we also looked at Japan. And Japan we chose both because you also have that long historic context, but also because Japan has been living through a very low interest rate environment for a very, very long time, right? And so we thought that might be a bit instructive in terms of what to expect here, given that most of the world has been suffering through the same kind of environment over the last couple of decades. So as you can see on the left side of the page, this is just measuring how does value perform versus the market during the recession. So when you are in the recession, you tend to get, in the US case, sort of mid-single digit outperformance of value, low double digit in the case of Japan. So the way to think about this really is, as we're about to go into the recession, we're at the end of the economic cycle, investors are beginning to discount the next recession. So they're already selling off those value stocks, and those stocks are getting cheaper, right? When the recession actually arrives, once it hits, now we know what bad looks like, and we can begin to discount the inflection in earnings that we see coming. And that's what's happening here. And then as we move out of the recession, that earnings momentum continues. So those cheap companies become the stronger earners over the next few years in that early part of the economic cycle. And that's what we see on the right side of the page, that if you continue to hold those cheap stocks for 5 years after the beginning of the recession, in the case of the US in particular, you get even more additional alpha moving forward. And so when we look at where we're sitting today, sort of coming out of this pandemic at differing paces around the world, certainly, we would expect to see the same sort of historic value cycle that's illustrated here. And what's really underpinning that, again, is this inflection in company earnings power. And you can see that on the next page in the case of our emerging market strategy. So this is just looking at our own stocks that we owned, indexing the level of net income that they generated back in 2018. So as you can see, very sharp fall in net income, pandemic induced for the most part. And then the recovery expected to come out of that, this very steep V-shaped curve. And it's really this big growth and this big inflection in company earnings that causes those value stocks to perform so well coming out of the recessionary period. Again, what we expect to see here. Now, in emerging markets, as in much of the world, we do have this big spread where the cheap is cheap, but the expensive is incredibly expensive. And we can kind of get into why that is. But the fact that that is, I think, makes investing actively in emerging markets even more important than in the rest of the world. And the reason for that is the concentration of the index and how expensive so many of the names are. If you take a look at the next slide, I think it lays it out pretty simply. So what we see here is what percent of the index is in the top 5 positions. So in the case of the EM index, it's always kind of a high number. You know, there just aren't that many companies. But today, it's pretty staggering. You know, nearly a quarter of the index is in 5 stocks. So if you are invested passively in emerging markets, there's basically no such thing. You're making a very big bet on those 5 stocks. And those 5 stocks today are quite expensive. You know, the PE ratio on average of the top 5 is 30 times. So you may think that you're invested passively in emerging markets and you're just moving along with the market, but really what you are is a very concentrated growth investor. And we think that's very powerful as we look forward for our portfolio as we anticipate the value recovery to come through. And then just to leave you with sort of a snapshot of how things are laying out in terms of our valuation discipline, again, focused on that price to normal earnings. On the next slide, you can see the global valuations. So again, you know, just to review, as investors, we're focused on this metric of normalized earnings power, which means what a business should earn in a sort of relatively benign environment. And when we're looking for companies to buy, we're hunting around in the cheapest 20%, that cheapest quintile. So that first column would be the valuations of the types of companies that we're researching and adding to the portfolio today. That's the midpoint of that quintile. And then the midpoint of each investment universe is our sell discipline, so where we would be selling. So today in the emerging markets, we're looking to buy companies that are somewhere around 7.2 times price to normal earnings in terms of the multiple. And then we would be selling those businesses when they reach 16 times. So it's still more than a double in terms of that journey from entry to exit in the portfolio. And as we look around the world, we see that that's the case everywhere. Pretty much everywhere, you're looking at a double in terms of the upside from the stocks today. So still a very, very attractive valuation cushion from our perspective. The reality is when you're buying these very cheap stocks, there is a controversy. You know, there's always a reason why these stocks are cheap. So when you have a really nice wide valuation cushion, you're quite comfortable taking the other side of that. So just to summarize on the next page here, you know, history shows us that value investing works. It shows us that it works even better in emerging markets. And that's part of why we felt confident to move into emerging markets as an investment strategy back in 2008. You know, sitting where we are today, the growth stocks are really at unsustainable valuations. Even with the wonderful performance of value over the last couple of quarters, those valuation spreads still look very, very high relative to history and relative to what really should continue to happen in markets at this moment, given where we are in the economic cycle. From our perspective, this doesn't change what we do. You know, the process that we have is the same thing we've been doing, you know, for 25 years. But we're very excited thinking, you know, where we sit today, where the valuation spreads are, where the earnings momentum is in our portfolio. And so, you know, I'm just happy to be able to share that with you today. And hopefully I haven't bored anyone too much. I'd love to hear, you know, your thoughts and if you have anything you would love to learn more about or talk about.
Well, Allison, it looks like we have a couple questions that have been put into the Q&A bank, and I would encourage everyone to continue to ask as we have a little bit of time left here. One of the questions that we received asked if you can maybe spend a little bit of time discussing a holding or a successful investment that has made its way into the portfolio over the last year and how the research process took place around that name.
Sure. That's a great thing to do. Do you want to move back to that page about the process? Because we can sort of walk through what we did. I forget what number it was. Back. 6. Yeah. So a company that we bought when the trade wars were really heating up was a company called Manhua. So this company makes recliner sofas in China, and they are number 1 in China, number 2 in the US after Lazy Boy. And the reason why the stock got cheap was because the US slapped a big tariff on these coming from China, along with many, many other things during the trade war times in the most recent presidency. And so the stock got very, very cheap. And we took a look at it. And what we found was that there were some key issues that the market was missing. Number 1, this company was currently building a second very large manufacturing facility in Vietnam. So they were going to be able to ship all of their US product from Vietnam in the future and avoid the very high tariffs. In addition, because this plant wasn't fully running yet, they were undergoing duplicative costs, and that was depressing the margin temporarily. The other fear that we had about this business was, well, once everyone starts shipping from Vietnam, you're going to have all of this trapped capacity within China that really can only feed Chinese demand. So we looked into that. And what we found was that Chinese demand for recliner sofas is still growing at quite a healthy pace, but maybe we were going to have too much capacity. That said, this company, being the largest, is also vertically integrated. So it's the lowest cost producer. So even if we have a bit of a price war in China, they were going to be able to make it through. We did all this work on the company. We visited with them, and we got comfortable with the sort of path to normalization that we saw in terms of the new facility getting up and running, their ability to compete within the Chinese market, and we added it to the portfolio. This is a stock that actually performed quite well. As you all know, China was sort of first in, first out in the COVID crisis. And along with everyone else in the world, Chinese people have been updating and upgrading their homes during this past year. So volumes have come through quite strongly in terms of sales for them this year. And that also enabled them to delever their balance sheet, paying off debt, and made the stock perform quite well. So we actually, that stock reached fair value in the latter part of 2020, and we sold it from the portfolio. Oh, you are on mute.
My apologies. You touched on in your example how this particular example or company dealt with COVID. The question that we had come in asked in general, how do we see emerging market economies weather COVID, and how are they doing as we sort of come out of the crisis that we've experienced last 15 years?
Yeah, that's a great question. And unfortunately, we are seeing a lot of diversity. Unfortunately, because of the human toll of this. You have some economies that are pretty much back to normal, like life in China. One company we own in the portfolio, Trip.com, we bought it last year because it got very cheap. No one was traveling. This is, a travel portal within China. But now domestic travel is pretty much back to normal, above 2019 levels in some cases. It's just that international piece who has yet to come back. So on one end of the spectrum, you have places like China. On the other end, you have countries like Brazil and India, right? Which I'm sure, as we all know from reading the news, are having a very, very tough time with COVID. Brazil is kind of an interesting case because pre-COVID, it had been relatively expensive the last couple of years since Bolsonaro came in. And so we had really struggled to find companies that met our cheapskate requirements to add to the portfolio. But Brazil was hit quite hard with COVID in the beginning as well, and the currency took a big hit, which enabled us to add a couple of great franchises to the portfolio. Itaú, arguably the best bank in Brazil, Ambev, beer giant, something like 2/3 market share in that market in Brazil, were both companies that we added last summer. But unfortunately, Brazil has not been emerging from the crisis. Things have actually gotten worse there more recently. In that case, we did add to our exposures in Brazil, particularly to Ambev, given the strength of that business, the downside protection in the balance sheet. That's one where we're comfortable adding, even when the pain is more severe. So I will say from a human perspective, the big range that we see in terms of countries' ability to manage COVID is difficult, but from an investment perspective, it's really an opportunity for us to grab some great businesses.
So the next two questions are somewhat related. So I'll ask the first one, then transition to the next one. The attendee posed this question: to what extent does the presence of a state as a shareholder in a target company, making it essentially a partially state-owned enterprise, impact your decision to invest in this particular name?
This, by the way, is a huge issue in emerging markets. You see a lot of state ownership in EM companies. And I will say even beyond state ownership, you find a lot of companies that are part of larger conglomerates. In Korea, those are known as chaebols. You find a lot of companies with family ownership. So you often find a big shareholder, which may be operating under interests that are not entirely economic. Let's put it that way. So from our perspective, we can't ignore these companies, right? They often trade at a discount for a reason, but sometimes that discount is more than it should be. I think you'll probably hear from other EM investors who will tell you, well, I won't touch state-owned businesses. But if that's true, then you're really hiving off a large portion of the market where there may be very significant investment opportunity. And I will say even beyond that, there are a lot of so-called private companies where the state can step in and do whatever they want anyway. I think a lot of investors in Alibaba were pretty surprised over the last 6 months, seeing the degree to which the government sort of scuttled the anti-IPO and the pressure being put on Jack Ma. So, should you really be paying such a big premium for that business? I think really the key here is to look at the behavior of the management team and the behavior of the government that's involved in the business when you're looking at an SOE, and to not expect that behavior to change, right? If history tells you that this business is going to spend an extra 20% of CapEx every year on social projects where they don't really earn much of an economic return, well, then we have to forecast that into our future as well. And if the stock is still very cheap, then perhaps it merits investing.
So Allison, as follow-up, how do you manage to minimize risk associated with political and social volatility? And then on top of that, can you walk us through a summary of your ESG implementation into the strategy?
Yeah, great questions. So this idea of country risk is really critical in emerging markets. And it's an issue that we wanted to make sure that we addressed thoroughly from the outset in this strategy, because history would tell you that which country you're in doesn't much matter if you're a developed market investor, but in emerging markets, it has been quite significant. So really we deal with it two ways. The first is with our bottom-up investment process, right? And in landing on a normal earnings number for every company in the portfolio, what we're really doing is trying to look at the long-term future of this business. So anything that could be affecting this business at a macro level in terms of politics and the environments in which it's operating should show up in that number. That's true across every company that we're invested in everywhere in the world. Then there's another piece that's unique to emerging markets businesses, which is we then apply different discount rates to those companies. And those discount rates are derived from the countries in which they're domiciled. Essentially, we get those rates from the bond market. So we take the 3-year average of the difference in yield between US 10-year treasuries and each country's dollar-denominated sovereign bond. And then we add that onto the discount rate we're using in developed markets. I'm sorry, that's a real mouthful. But the way to think about it essentially is that because of these different discount rates, $1 of earnings when it's coming out of Russia is worth less than if it were coming out of South Korea, which is worth less than if it came out of the US. So that helps to account for some of those sort of country risk factors that we think about, when we're in the emerging market environment. And then to the other question on ESG. So for us as long-term investors, looking at companies' normalized earnings power, inherent in that is sustainability, right? We're only looking to buy sustainable businesses because that's the whole concept of normalized earnings power. And so from that perspective, we consider our strategies to be ESG integrated, because whatever the major issues are that are affecting a business, that's where we want to be, whether they're purely economic or purely ESG in nature. Companies can be doing things both from a positive and from a negative standpoint that will affect their long-term outcome in an ESG way. And so while our team is organized by industry globally, each analyst, in addition to that industry specialization, needs to be able to analyze the ESG elements of those businesses. But then beyond that, we also have two other members of the team who are purely ESG focused research analysts. So the way to think about it is sort of like an overlay, like a weave. You have your industry analysts, and then you have these two ESG focused members of the team as well, who really keep us all abreast of what's happening in the ESG land space. They get involved in company research and engaging with management teams sort of as needed on ESG issues. They also help us to record and communicate what we're doing from an ESG perspective. And then beyond that, ESG is also an area where we've been thinking sort of big picture in terms of the white papers and the commentary pieces that we work on as a team. And we recently wrote a paper looking at the relationship between ESG scores and stock price performance, and also changes in that. Actually, I think we have these slides in the appendix. Yeah, we do. Why don't we go back to 23? Yeah, so what we're looking at here is, it's sort of a longer paper, which if anyone's interested, ping Marty and we can get it to you. But what is the performance of stocks based on their ESG scores? So just to take a step back, the way that we invest in ESG is not based on scores. So we do subscribe to MSCI. So, we can see the scores, and there are several different services that will put these scores on companies. But there are problems with them because, what does a score mean? It can mean different things. But at any rate, for the purpose of this study, we just used the scores from MSCI, looking at the highest all the way down to the lowest, again, looking at 5 quintiles. What are the scores of those quintiles? And then how did those stocks perform? And as you can see, you don't get a whole lot of information on this. I mean, it's certainly in the global universe, you would say it's basically a wash. I mean, the lowest quintile, so the worst ESG scores did a little bit worse, but the best performing stocks were actually the second worst quintile in terms of ESG scores. So not a lot of info there. On the US side, the bottom part of the universe, the scores look directionally a little bit more helpful, but none of this is very significant statistically. Now, the next thing that we looked at, I think, is actually a bit more interesting, and that's on the next slide, I believe. And that's the relationship between an improving ESG score and how a stock performed. So what we're looking at here is not the static scores themselves, but looking at the change in those ESG scores. So the first quintile here is the set of companies that saw the biggest improvement in their ESG scores. And as you can see that focusing here on the global universe, the average improvement amount in that first quintile is up 2.27 points in ESG score. And then, you can follow all the way down to the lowest improvement quintiles, those companies whose ESG scores actually went down over time. And those went down on average about 1.5. And this, I think, is much more interesting to look at. And you can see, had a much bigger effect on the returns, or I should say correlation on the returns, because we can't really get into whether this caused it. But as you can see, the companies on the global level who had that biggest improvement in scores had an average 3-year return of almost 29%, whereas the ones who had the lowest improvement, or actually where the scores got worse, only had a 19% return over this period. And so, this data is more powerful, and quite honestly, this is much more what we're focused on. We are not focused on saying, this is a good industry, this is a bad industry from an ESG, so we will own this one and we won't own that one. From our perspective, the real key focus here is on engagement, because if we can identify instances where companies are improving on these ESG elements as they could be on any other business element, that's really what we're looking to tap into, because that's where we think we can create alpha in our clients' portfolios.
Allison, I'll try to get to a couple of these other questions before we close things out. One question that came in is one that we get a lot, and they ask, what are generally the implications of a rising interest rate environment for emerging markets? And do you have any comments on inflation as well?
Yeah, so this is, obviously the question that everyone's asking these days, sitting where we are in the rate environment where we are. And, I think a slide that might be helpful to look at here is page 22. It's a little bit busy, so I'll try to get through it quickly. But what we're looking at here is interest rates. Here it's US 10-year yields, but I think this is also relevant for emerging markets because so much of EM does react to what's going on in the US. And then you have, currency moves as a result of that, which sort of can exacerbate the situation. But what you're looking at here is, rates went up, it sort of peaked in the early 80s and have basically been declining ever since. And the effect that that has had on stock price valuations and on your experience as a value investor. The other lines on this page, the blue line is what is the simple valuation, price to current earnings ratio for the cheapest stocks in the universe. As you can see, the cheapest stocks tend to trade at a mid to high single digit PE, going all the way back, 60 years. So no big change there. The orange line though is the price to earnings ratios of the most expensive stocks. And this is really critical. And this is where declining interest rates have had a huge effect. As you can see, that orange line has been going up and up and up the whole time the interest rates have been going down and down and down. This makes sense. Simple math. If you have a business where more of the earnings are out into the future and they are growing, as the interest rates are going down, simple arithmetic, you're putting an ever lower discount rate on that stream of earnings. And that's how you're arriving at your valuation multiple. So as interest rates are going down, PE multiples on growing businesses, growth stocks should be going up. And that's what we've seen here. And honestly, this has been one of the biggest drivers of that valuation dispersion that we've been talking about. Now, where are we sitting today? Are rates going to continue to go down? Are they going to stay the same? Are they going to go up? I wish I could take a poll of everyone here because I'll be pretty surprised if anyone sees them going down further. Though, as we all know, don't discount the Fed. But at any rate, if we see rates stabilize here and or go up, that is almost always a good thing for value stocks in general. You see the multiples on the growth stocks come down. When you look at the environment where we're sitting today in terms of which industries are cheap and which industries could benefit from rising rates, financials are a huge component of our emerging market portfolio and our portfolios around the world today, given valuation. Rising rate environment would be quite positive for most of those businesses. So from a value perspective, a rising rate environment would be a good thing. Then when we look at emerging markets, that is also for the most part true. The thing that you have to watch in emerging markets is that interplay between interest rates, inflation, and currency. And this is where really making sure that you're invested in the right businesses with the right balance sheets and the right currency exposures can become really important, because many emerging markets investors have gotten burned when you have those sorts of currency mismatches and things move very quickly. We saw it in the taper tantrum just a few years ago, and you can see it multiple times going back historically in emerging markets.
So we did have a question about if we avoid companies, and you sort of answered this, companies or countries where currencies are unstable or there is hyperinflation. Do you have any additional comments on that?
Yeah, so we don't have any sort of hard and fast rules, but certainly if the volatility in the currency is making the range of outcomes for a business just too wide, then we won't be able to invest even in a very cheap environment. I can remember an example a few years ago, we were looking at this bank in Nigeria, but not only was the currency unstable, the actual FX rate was almost unrelated to the reported rate and the reported rate in the financials. I.e. everyone expected a big devaluation about to come. And in this case, we were looking at a bank, which by definition is a levered business. So, not a lot of downside protection on the balance sheet. And in that case, we had to pass. From our perspective, we don't look to forecast currencies, but if there has been any benefit to earnings and just due to currency moves in the history of the company, we strip those out. So we don't let the company have those in the normal earnings number. And then beyond that, if this is a company that's operating in a volatile currency or multiple currencies, or has any sort of mismatch on the mismatch on the balance sheet, those are things that we'll take into account when we're trying to analyze the range of outcomes for that business, which in some cases, can overwhelm even a very cheap valuation.
It looks like we have one more question here, and I think your answer, Allison, will kind of summarize our fundamental research-driven approach. The attendee asked, they commented on the fact that we have a lot of data of the cheapest stocks outperforming the most expensive. Would it be prudent to just invest in a basket of the cheapest stocks versus a actively managed approach?
Oh, you're saying buy the whole first quintile?
Yeah.
You could do that. So when we've looked at it historically, basically, you could buy the whole first quintile, so all 300 companies, and that will outperform the market. Our portfolio has done better than that. And the reason is, if you're owning all of those companies, all the cheap companies, you're going to get whatever upside exists in that cohort, but you're also going to get all of the downside, i.e. all of the companies that might be headed to zero. And so I would say, when I think about what's the value add of the research process and of the research team and how do we justify our own existence, obviously a piece of that is in correctly identifying the companies that are going to go up. But the bigger piece and the bigger value add that we've had over time is correctly weeding out the companies that are headed to zero. If you think about what's in that cheapest quintile, every company that's on its way to bankruptcy will flow through there, right? So just avoiding those can help you to generate pretty significant alpha.
So I believe I got through all of the questions that popped up in the Q&A in the chat. If there's anything else, we have a couple more minutes, Aaron, or anyone else. If there's anything you'd like to ask directly to Allison, feel free to. Otherwise, we really appreciate your time. And as I mentioned, if anyone has any follow-up questions, or if we can help in any way, or if you'd like the presentation, please feel free to reach out to me.
Thank you, Martin and Allison, and thank you to everyone who connected with us today. Please be on the lookout for an event survey to follow, including the audio and meeting presentation. I hope you all have a great rest of your day.
Thank you.
Thank you so much.